Hey everyone, welcome to this explainer. Look, if you're gearing up for those ICAI exams, you already know that Standard on Auditing 560 can feel, well, incredibly dense. But today, we're going to completely demystify it. Consider this your ultimate fluff-free textbook replacement for SA 560. We're going to break down subsequent events so thoroughly that you'll have total conceptual clarity by the end of this session. Seriously, you won't even need to open that textbook again. Okay, let's dive into this. Here's our exact roadmap to conquer the topic. First, what are subsequent events? Second, the three crucial dates. Third, adjusting versus non-adjusting events. Then, the auditor's changing responsibilities. After that, practical procedures and dual dating. And finally, mastering the ICAI exam itself. So part one, what exactly are subsequent events? Before we get into the when and the how, we really need to firmly establish the what. By definition, subsequent events are those events occurring after the reporting date, your balance sheet date, but before or even after the auditor's report is signed. The whole objective for the auditor here under SA 560 is to get sufficient appropriate audit evidence that these events are appropriately reflected in the financial statements, or that the auditor's report is properly amended to deal with them. It's basically all about making sure the financial picture remains absolutely accurate, even after the year has technically wrapped up. Let's move to part two and see how this builds. The three crucial dates. You literally cannot understand subsequent events without mastering the chronological timeline of an audit. Everything, and I mean everything in SA 560 revolves around three specific markers in time. T1 is the reporting date, or the date of the financial statements. Think March 31st. Then T2 is the signing date, which is the exact day the auditor signs off on the report. And finally, T3 is the availability date, the date those audited financial statements are actually issued. Now that third date is absolutely critical, right? Because that's exactly when third parties like investors, banks, and the general public actually start relying on those numbers. I want you to burn this timeline into your memory right now. As you'll see in a sec, the auditor's duties completely shift depending on exactly where we are on this timeline. Part 3, adjusting versus non-adjusting events. We're transitioning into the core accounting treatments now, which is arguably the most heavily tested concept in the whole standard. You need to know exactly how to treat an event when it happens. Whenever an event happens after year-end, you've got to ask yourself one direct question. Did the condition exist at the balance sheet date? This single, highly focused yes or no question is your ultimate filter. Literally every subsequent event scenario you'll face in the exam hinges on your answer to this. And this brilliantly illustrates why. If the answer is yes, the condition existed at year-end, boom, it's an adjusting event. It gives us additional evidence about conditions that were already there, so you absolutely must adjust the financial statements. Like, imagine a debtor who owes you money goes bankrupt on April 10th because of financial struggles they had all year. You adjust that provision for doubtful debts. On the flip side, if the answer is no, it's a non-adjusting event. You don't touch the numbers, but if it's material, you've got to disclose it. Picture a factory completely destroyed by a fire on April 15th. Or, the classic ICAI trap, a dividend declared after the balance sheet date. These arose purely post-year-end, so no adjustment, just a disclosure, because users of those statements still really need to know what's going on. Moving to part 4, auditors changing responsibilities. With those dates and treatments locked in, how does the auditor's actual day-to-day job change as time marches on? Now, what's really interesting here is the stark contrast between what I like to call active duty and passive duty. In that first period, from the financial statement date to the auditor's report date, the auditor is on active duty. They have a mandatory responsibility to actively perform procedures to hunt down and identify subsequent events. But the split second that report is signed, we enter period 2, and eventually period 3. Here, the auditor drops straight into passive duty. They have absolutely no obligation to keep searching for new events. However, and this is a massive however, if a material fact just happens to fall into their lap, they can't just ignore it. They are still required to act on it. Which brings us to part 5, practical procedures and dual dating. When the auditor is in that active duty phase, what exactly are they supposed to be doing? Getting that sufficient, appropriate audit evidence basically means playing detective. You don't just sit back, you investigate. You got to read the minutes of board and committee meetings held after year-end, looking for clues. You scrutinize the latest interim financial statements to spot anything weird. You directly inquire with management about significant events. You review post-year-end legal correspondence, to see if any surprise lawsuits popped up out of nowhere. And you examine major subsequent transactions like huge asset sales or new borrowings. It is a highly active, multi-channel investigation before that ink dries on the report. But what happens if you're in period 2 or period 3, so after the report is signed, and some massive material fact suddenly comes to light? Well, the standard gives us exact chronological steps. Step 1, you've got to discuss the matter with management. Step 2, determine if the financial statements actually require an amendment. If management agrees to amend them, you move right to Step 3, which is performing the necessary audit procedures specifically on those amended statements. And finally, Step 4, you issue a new or amended auditor's report. And that naturally leads to a really fascinating concept, dual dating. Let's say you finished your audit and signed the report on April 30th. But then, on May 10th, before the statements are issued, one single specific event happens that requires an amendment. You definitely don't want to take responsibility for actively auditing the entire company all the way up to May 10th, right? So, you use dual dating. You keep the original report date of April 30th for the audit in general, but you tack on a second date specifically for that one note. It brilliantly isolates your extended responsibility to just that single event, which protects you from having to reopen the entire audit from scratch. All right, Part 6, Mastering the ICAI exam. We've covered the conceptual framework beautifully, so let's pivot into some high-yield exam strategy to make sure you turn all this understanding into actual marks. Listen, the ICAI examiners are looking for very specific terminology. If you want full marks, you absolutely must memorize and use these exact keywords. Don't just call something an important thing. Write material fact. Talk about the amendment of financial statements, explicitly mention dual dating, and always frame the auditor's goal as obtaining sufficient, appropriate audit evidence. Oh, and of course, correctly name those 3 dates we talked about. Speaking the examiner's language, that is literally half the battle. So, the crucial point is how you pull all of this together when you're staring blankly at an exam paper under pressure. I want you to use this massive mnemonic, the A and D rule. Honestly, this is your ultimate cheat code. A stands for adjust. If the condition existed at year end, it's an adjusting event. You adjust the statements. N stands for note. If the condition arose after year end, it's a non-adjusting event. You note or disclose it. And D reminds you that dates matter. The auditor's duties completely change depending on the stage of the audit. If you can just remember A and D, you can construct the entire SA 560 framework right from memory. I'm going to leave you with this final provocative thought. If a major fraud at your client is discovered tomorrow, will you know exactly which date on that timeline determines your professional liability? Mastering SA 560, the timeline, and the AND rule isn't just a trick for passing the ICAI exams. It is quite literally about surviving real-world audits and protecting your professional license. Trust the framework, and you'll navigate subsequent events with absolute confidence.